Welcome back. You're watching Stock Watch with me, Zinati Kuma, and joining me to take your stock-related questions tonight are Jean Pierre Verster from Protea Capital Management and Drikus Combrinck from Capicraft. Please be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag Stockwatch. Thank you so much for your time, gents. Drikus, I want to actually start off with you because it seems that the market is down significantly today. Is there anything specific? Quite confusing to me, considering the dovish comments that we've had from Fed Chair Jerome Powell.
Yeah, so I don't think this is anything fundamental, or I don't think there's any market-moving news that broke locally, at least. I think late afternoon yesterday, a big player came into a market. Certain shares were bid up quite significantly in the closing auction, and I think what we're seeing today is just a reversal of that bump up, that gap up in stock prices. So we're seeing a bit of a reversal of that. So if we cancel that out, a lot of other stuff that did not move yesterday is actually up today. Something that was down yesterday, like Sasol, is up quite nicely earlier this morning. So I think that's the biggest movement on the market today, and that muddies the water a bit. Yeah, I'm not sure what else is happening at the moment, to be quite sure. That's,
Yeah. The comments coming out from Powell, JP, do you think that they have moved anything significantly so far?
Doesn't look like that, but it's also an open question how long Powell is going to be around. Especially if we get a Trump presidency, might not see the end of his term. So who knows? So at the moment, as most times, people are hanging onto his lips, and he's got quite a balanced view, it seems, in terms of inflation and the importance of fighting inflation. And maybe if there's a new Fed chair at some point, maybe it's someone who doesn't really mind inflation as much as Powell might. So for now, people think that maybe we'll get an interest rate cut later this year. I'm sure Trump will also like that, and maybe that means that Powell can see the end of his term. But yes, central bankers at least are having less of an influence on markets, I would say, than 3 or 4 years ago. It felt 3 or 4 years ago like literally markets were just being moved in a position based on what the Fed did. And they still have a big impact, but at least it feels like some fundamentals are coming back into driving share prices, which is a good thing.
All right. Well, taking a look at share prices, there is a question here. All the telecoms counters are down by a similar margin today. Anything specific for that pressure, Drikus?
No, you've got me. Maybe a bit of yield curve. I see the yield curve has picked up quite a bit yesterday. So we had a sell-off in the bonds. They're quite yield curve sensitive, I would say, because they've got the current cash flows that you have to basically just discount by the yield curve. So no, nothing industry specific that I can see.
All right. Well, I mean, just on a fundamental level, it seems that the telecoms sector has a lot of sensitivities. Would you have enough appetite for those sensitivities, JP, or not, in terms of the telecom sector?
So one of their sensitivities is the discount rate, because they are such high dividend payers, so more near-term cash flows, as Drikus also referred to. And that sensitivity means that if there's any cut in their dividend, they would not react well. So they would be sensitive to that. It's a very mature industry. So we have seen cuts. If you don't go back too far back, you can think of MTN. They cut their dividend and the share price did not like it. The other sensitivity is foreign exchange, different currencies. So for MTN, it's the Naira. For Vodacom these days, it's the Egyptian pound. And that's another sensitivity which the last few years has not been good, because these African currencies have not done well. And because of these sensitivities, I'm not a fan of the telco stocks being mature and sensitive to certain risk factors that actually have become greater risks. So my preference is not to invest in these telco shares listed locally, no.
All right. Well, I mean, talking about maturity, Richemont actually came out with a sales update today, seeming that the growth was pretty tepid, although they did cite a high base in the comparative period. Drikus, what did you actually make of that update today?
Well, it's not as bad as I thought it was going to be. I thought it was going to be worse. We've been looking at some, let's call it anecdotal data. Some watch resellers, they post data on the resale volumes in Eastern markets, and it doesn't look good. And that's on the used watches, etc. Those volumes don't look good at the moment. So, and we do know the Chinese economy is buckling a bit under a lot of structural factors. I think the heyday of Chinese buying Swiss watches for dishing out presents everywhere, I think that's over. But it's still a high sales level. It's still a healthy level of sales for Richemont. The share price though is still discounting a lot in my view. Sure, it's come down a bit, from where was it, 3,200. Yeah, it's come down a bit, but still, it's just not obvious value or even an obvious growth opportunity in my view. So unless there's going to be a big increase in the Gini coefficient globally, where you just get the wealthier getting much more wealthier than the rest of us, or where you've got a big pickup in Chinese business spending.
Yeah.
Or Chinese tourism that might come through. I just don't see, Richemont doing much from here.
Yeah. Yeah. Do you think, JP, that Richemont has kind of reached the peak of the high times that we've seen recently?
I think it's probably reached a recent peak.
Okay.
Because if you really look at long-term trends, the luxury goods market can be cyclical because you also get these different cycles of wealth creation. And when stock markets do well and property markets do well and you create a lot of millionaires and billionaires, luxury goods businesses do well, and then we have lower markets, lower property prices, the opposite happens.
Yeah.
So we've had a big run-up in equity markets. And in China, the last few years, we've now had a downturn in equity and property markets. So that does mean that we've sort of gone just over a peak in luxury spending, with different parts of the world being at different places of this cycle. So China being maybe near the low end of a cycle, US potentially near the upper end of the cycle, Europe probably somewhere in the middle, Japan also quite high because of the weakening of the yen. A lot of people are buying the luxury goods businesses in Japan. So it does mean that you need to look at these businesses through a cycle. And Richemont does look a bit full if it is near the top of its cycle. And some other businesses look a bit cheaper. But then there are businesses who have also struggled. In the last few days, we've had results of Hugo Boss, the German luxury goods business, and Burberry, the UK luxury goods business, and they both came out with terrible results. So the Richemont results is sort of a relief. And now we wait for LVMH and Kering and Hermes and some of the bigger players to see how they have done the last while, especially in China. So it's an interesting time in the luxury goods sector.
Yeah, because I was actually about to ask, I mean, yeah, you mentioned Burberry and Hugo Boss as well. Drikus, do you think that at some point, at this point that investors who do have an appetite for that industry maybe need to apply a little bit more caution than was warranted before?
Yeah, listen, I'm bearish at the moment.
Okay.
So
yeah.
the last thing you want to do when you're bearish is go out and buy luxury companies. Sorry, so I'm not even going to go out and venture as to suggesting one or two. So yeah.
Well, JP, are you bearish or cautious?
I'm cautious.
Okay.
I do think most of these luxury goods businesses are fully priced. I'm not quite from cautious going to bearish, wanting to short them.
Okay.
I think we need to see a crack in the US equity market, and then I'll certainly consider shorting them. But I first want to see the crack in the US equity market. But they do look full, so I agree with that.
All right. Well, there's a question talking about going into other sectors. Is rotation in stocks from the U.S. tech stocks the name of the game right now? Drikus?
Rotation from where?
Out of U.S. tech stocks to other sectors.
Yeah, so what we have is just these passive inflows pushing up, what you might call the S&P 500 top shares, the Max 7. There's an argument being made that as long as we've got employment growth in the US, you will get 401ks, that's their retirement plans. These funds will be, channeled into the top stocks. That's what they typically do. So that gives this impetus into those Big 7. Obviously, a lot of fund managers were caught short of these and they had to chase performance. Those have pushed up the prices even further. But like a jet airplane going up vertically into the air, it does run out of oxygen one time or another. And we had some, let's say, flutterings of that jet engine the last week or two. We saw that with NVIDIA dropping a few percent, a few days. And we might see, that stuttering of that engine. I'm not sure that we're there yet. It's a dangerous game trying to time these stops. I'm not in that game. But I would say that there will be some kind of rotation. But because what a lot of hedge fund managers do is to buy those shares, they finance themselves by shorting a different part of the market, typically something or a basket of shares in the Russell 2000, and so we saw a bit of that reversal last week. I think it was on Tuesday. We saw a big reversal there. Is that a new trend? I don't think so yet. I don't think we're there yet. I think what needs to happen is a change in the yield curve. We saw a bit of a change in the yield curve, obviously, last week, but we need to see a more steeper yield curve. Short-term rates did come down last week, but we didn't see a pickup in long-term rates. If long-term rates picks up sufficiently, it will cause a sell-off in your growth stocks, in the technology stocks, the Nasdaqs, the Max 7s of the world, and you'll see some sector rotation coming in, unless, of course, that is a disorderly sell-off of the long end of the curve. Then you'll just see everything getting sold off.
All right. JP, for U.S. exposure, do you think that it's time to be giving oxygen to the other sectors?
Well, like Drikus also said, it's a dangerous game if you try to time markets. You should rather try to price markets. So look for assets that are keenly priced, that are priced that you think is an attractive entry. Doesn't matter where in the cycle you are, because if people could forecast exactly how cycles play out, they would make a lot more money than what they actually do. So it is very difficult to forecast the future by definition, and the change in the future or the change in cycles. So yes, we saw this fluttering last week of tech stocks getting sold down and the rest of the market going up. But again, instead of trying to forecast what the cycles are going to do, some of the tech stocks look fully valued to me. They look quite expensive. Some look very expensive. So most of the value opportunities that I can see is not in the Mag 7. It's a bit lower down, some smaller capitalization stocks, not necessarily still above $1 billion, so not small from a South African perspective, but there are opportunities. So I would say don't worry too much about the cycles. Focus on looking for companies that you think the price is attractive.
All right. Well, talking about price, there's a question on Altron. Altron's share price has moved at a pleasing momentum over the last year. Is there still room for more upside? Drikus?
Well, yes, I do think it is. It's not as cheap as it was, obviously. I think the management team, as well as some of the previous managers, and Nyati obviously was at Altron and is now the head of the ESCOM board, has done tremendous work as Altron. So he set that company straight, and it's still looking good. They're still benefiting from the changes they made. It is, to a large extent, there's a lot of SA Inc. Businesses in there. Obviously, it's listed on the JSE. If you think that the SA market has some room to run, I think most equity managers, most institutional managers locally and abroad is still very much underweight SA Inc. And they might continue to pour into, as they did just after or just before the election, they might continue to move back into shares like Ultra. So I do think there's more upside, yes.
Okay. Yeah, it has actually run a lot.
It's not Ultron specific.
Yes, okay. Well, Ultron specific, it has run a lot. JP, would it still look good to nibble on right now, or maybe just wait a little?
It still looks okay. I think the big turnaround between Nteto Nyati and Werner Kapp, a very good job in turning around this business, cleaning the balance sheet, sorting out legacy issues. So well done to both the last two CEOs. And there's probably a little bit more to go. But now you want to see the organic growth take over from just the turnaround, just the cost cutting. And it's going to be interesting to see what they do with some of the assets like Netstar. It still seems now a little bit like the full value of all the underlying businesses within the Altron group are not necessarily reflected in the share price. So it was definitely a case of that a year ago, a bit less so, but still there could be some space for corporate action which could unlock a little bit more value. So it still looks decent, but the time to have bought Altron, I think, was a year or two ago. And if they come out with some organic growth in the next results, then there might be another leg to the rally.
All right. Well, talking about rallies, we did have one on Bell Equipment yesterday. Hold or sell Bell Equipment as it stands? Of course, yesterday we know that it had an uptick of about 40%. Drikus, was this one that was on your radar?
Yes, but I grew tired of waiting for something to happen and took profits at some stage. Yeah, just because there was other opportunities that we were more sure of, that we thought we had the inside track on, but not inside info, inside track on. Yeah, so yeah, it's a big premium, I must say. I know a lot of guys that think Bell is worth even more, but it's a big premium from the recent share price, and the chances that this deal will close looks likely, and it's not going to take too long. The difference, I think, is 53 rand. It's the offer price. The difference between the current price and the 53 rand offer price is basically just the time value of money that you're going to wait for those funds. So yeah, if you want to move on from here, you're welcome. I don't think there's going to be another offer or a bigger offer.
Yeah.
The premium is quite large.
All right. Yeah, JP, hold or sell right now?
I would be comfortable holding.
Yeah.
Like Drikus said, you still have the time value of money.
Yeah.
And if they get the deal done quite quickly and you get paid a bit earlier, you'll get a return better than cash.
Okay.
So I quite like the dynamics at the moment. And I do think the deal has got a high probability to be implemented in a relatively short space of time. I do think it's a good offer. So it's a win-win because it's a good offer relative to the share price of the last few years. But it's still a slight discount to the tangible net asset value of the company. So I think minority shareholders are winning because they're getting a very big premium on their shares. And with a controlling shareholder, you never really knew if the share price was going to reflect the true value of the company. And the insiders are part of this consortium that are buying them out, which is basically the management team, family, and then a well-known hedge fund manager firm, which did well to catalyze this deal. They'll also be winning, because they're effectively buying it just under a net asset value. So I think it's a win-win deal. I like it, and we're still holding on to our Bell stock until we get paid.
Yeah, all right. Gents, I had a very interesting conversation earlier about famous brands and Spur. Yeah, and it was actually quite interesting, seeing the differences between quick service versus casual dining, and obviously the different kind of pressures that they undergo, but also the opportunity that clearly Spur has found. And looking at Spur, how it's basically outperformed. Drikus, what would you say about famous brands versus Spur at this point?
Well, yeah, versus the two, they both need the middle class to grow, which has been struggling the last few years. But there's a bit more hope, I think, in the short term, if there's some confidence coming back into the economy. then both of them will do better. Famous Brands heyday was long ago. I think they made a lot of capital allocation mistakes in the past, and I do rate Spurs management team at the moment, and I do think they're making a lot of they're making better asset allocation decisions in the last few years, especially after that debacle they had with can't remember quite when it was, a few years ago.
Yeah.
They were boycotted and they had a race incident, and since then they've just put their hammer down, and they've had a really good decisions since then. So I do think Spurs actually the better pick between the two.
All right. And I think we're also seeing there in terms of those share price boards. JP, do you think that investors are more cautious on Famous Brands due to the mistakes that they've made in the past, and that there's maybe just a little less confidence than on Spur?
It does look that way. If you look at the share price move of the last year, I mean, Famous Brands is flat over the last year, over the last 12 months. Spur is up quite nicely. And Famous Brands are still paying out quite a large proportion of their free cash flow in dividends. Because there's also a family that don't control the business, but the Halamandare's family still has got significant influence on the board. And we saw with Pick n Pay what happens when a company pays out too much of their cash in dividends. So I wouldn't mind if Famous Brands actually held a bit more of their cash back to decrease the debt levels. They are still reasonably highly geared. They would say comfortably, but if you have a hiccup, comfortable can become uncomfortable quite quickly.
Yeah.
And that's what happened with Gourmet Burger Kitchen. When it didn't work out, then the debt levels became uncomfortable very quickly. So I like both, and I'm looking forward to maybe a little bit more conservatism on the balance sheet of Famous Brands. And if that happens, I think there's a lot of upside because for me, there's a lot of value in Famous Brands, and the share price is not reflecting, I think, the full value if you can get a more conservative approach towards the balance sheet.
All right. Well, gents, let us get to your stock picks for today. Drikus, what are you choosing?
Well, in light of a bit of SA Inc., let's call it optimism, I'm going for Momentum. Momentum on its balance sheet has got a lot of SA debt, and that's done quite well the last month. I think it can continue to do well, especially if bond yields stay well behaved globally. We've got a bit of a interest rate, let's call it declining cycle, and in a lot of economies, I think we can have a few interest rate cuts locally as well. So I think that bodes well for local interest rate sensitive stocks. Insurers are definitely one of those. They feel it definitely first on their balance sheet. That will increase NAV. Momentum is already trading on NAV. Embedded value will probably come out in the next reporting period in the high 30s. Let's call it 37 Rand for a company that's trading below 23. Proper discount to embedded value, and with some upside to that embedded value. Obviously, again, middle class not growing, or the mass affluent market or the wealth market that they have not growing as it did 10, 20 years ago, but still a proper business, and they've done well to turn around the ship the last 3 years. And then there's obviously a few options for them. In the short term, they might sell the Metropolitan book. They've just had a name change. So watch the space for some corporate action as well.
All right. JP, what are you picking today?
I'm also picking an SA Inc. stock. So we spoke about Bell and getting bought out after a long period of being very cheap. And finally, someone came along and could catalyze a buyout because they came with a solution that turned out to be a win-win. So I've been looking around, could there not be some more stocks in the SA market that have been very cheap for a very long time? And Caxton is one that gained my attention. It's trading at a significant discount to its net asset value. It's got a lot of valuable assets, whether in newspaper and print. There's still some free newspapers around, the community newspapers. It still has got some advertising in that's doing much better than typical newspapers that need to get sold. And some packaging businesses, some other media businesses. And if you put them all together, you get a value of the Caxton group that is significantly higher than the current share price. But that has been the case for a number of years. So hopefully between the controlling management team, Moolman and Colburn, something can be done to catalyze another buyout, perhaps, and we can have another win-win. So I'm hoping that something like that can happen in the case of Caxton.
All right. Well, thank you so much for your time, gents. Much appreciate your analysis today. That is all for tonight's Stock Watcher. Thanks to our guest, Jean Pierre Verster from Protea Capital Management and Drikus Combrinck from Capicraft. Up next, The Close. Stay tuned.